What's good, everybody? Welcome to the Doe Show. Happy Monday. Hope you're having a good day. I will start by apologizing for the noise. We have lots of things going on here in the new place today, and I failed to think about how that might affect our show. So if you hear a little something, don't worry about it. We're just making good progress. And actually, I was thinking about doing a YouTube story later. I guess they have stories to kind of show you the progress around here for those of you that are interested. So I will be sure to do that in between now and the 5 o'clock show for you. But apologize for any sort of noise. All right, if you're watching this for the first time, we're financial advisors with Jazz Wealth Managers. Basically, we're financial advisors, SEC fiduciary registered financial advisors. If you want advice, someone to pay attention to you when you have a question, someone to help you walk through anything that you need, invest for you, handle all your investments, your 401k too, or 401k as well, no matter how big you are, right? Whether you have $1,000 or whether you have $1 million, you want someone to pay attention to you. That's really what we're here for, and we'll teach you all along the process with our wine and wealth classes on Thursday nights. We're going to expand on that, by the way. But today, for those of you that are watching and just interested in what we have to offer, I want to share with you a few things you might want to do at the end of the year. They're sort of checklist items for me that I like to do by the end of the year, and some of them are very, very important, so we'll get right into it and play the game. The first and most important, while I have your most attention, is capital gains, capital losses. Here's what happened. You know, or maybe you don't, when you're trading and buying and selling in a taxable account, you may have gains. And at the end of the year, your brokerage firm or us, we're going to report to you, you have this much in gains. You need to tell the IRS because we're going to tell the IRS. And so what happens there is that could potentially count as income on your tax return. Well, if you have losses, those realized losses get offset against your capital gains. That's just a fancy way of saying when you, that's just a fancy way of saying the word realized is when you actually realize the gain or actually realize the loss, meaning you bought something or you sold something right at that time of the transaction. That is a capital gain or loss. And so basically, think about what happened earlier this year. You had a great year. I mean, the first 6 months of the year, people were going, yeah, man, I'm killing it. I got my FANG stocks. I got my Microsoft, my Square. Everything's going well. My Bitcoin's doing good. Well, whatever. So a lot of you said, hey, I'm doing well. I've been making money trading in my outside accounts. See, a lot of our customers are actually like traders. They like to buy and sell stuff in their outside accounts, and I try to help where I can. So the first part of the year was great. And when you saw a profit, you took it. Now think about what's happened in the second half of the year. The markets have fallen rather aggressively. What do traders do when the markets fall? They go, wait a minute, I'm going to hold that position. I don't have a profit. I'm going to hang on to that position and wait for it to recover. Well, that could be a very bad thing to do because now you have all these capital gains and no capital losses because you refuse to sell a losing position or a position that's underwater. So what I want you to do is take a look at your capital gains for the year. If you did well in the beginning of the year and you're in your Robinhood account or TD Ameritrade, wherever you are trading and you did well, it may be beneficial for you to go into your account and say, I have a string of losers here. Yes, the markets have fallen. We've all taken a hit in the short term, but is this the time to go, hey, I've got this tech stock. It's down 20%. What's the chances of that recovering in the next 5 months, 4 months, whatever? It might make more sense to use that loss to offset some of your gains. Now you have until December 31st. Your capital gains and capital losses always take effect in the year that you do it. So it's a little different than if you can, like the IRA rule and Roth IRA, where you can contribute up to tax day. This is different. When you actually hit the sell button for a profit or the sell button for a loss, that's the year that we're going to use. Well, the IRS is going to use, not me. I don't care. So that's what they're going to use there, okay? So if you have some losing positions, even if you don't have gains, let's say you just started investing in your taxable account in the last 2 months, and you go, this is horrible. I just started investing and I'm losing. The markets are falling. What's the problem? Well, you picked a bad time and that's going to happen. But even if you have no capital gains, you can write off capital losses. If you're married filing jointly, a single person, you can write off up to $3,000. if you happen to have more than $3,000, they just carry over into the next year. So if you lost $5,000 this year, you can realize that loss if you want to, write off $3,000 against your income, short-term capital gains, write it off against your income. That reduces your income by $3,000, and then there's $2,000 left over. We'll just apply to 2019. So it's not necessarily a bad thing if you're struggling right now as a short-term trader, or if you just happen to invest in a taxable account and want the best taxable, I should say the most efficient taxable situation. So do me a favor, take a look into that. That one is really important because, you know, the clock's ticking. So after December 31st, if you happen to go, all right, Christmas is over, everything's good, you take a look, it's too late. You know, you're going to start writing off losses or gains into the next year. So don't find yourself with $10,000 in capital gains and no losses to write off against it. There's just no need for that. If you do a little homework, dig in, see what you can do. That's that. Okay, let's move on now to beneficiaries. Number 2, this one's just a checklist item. Very simple. Go into your account, go into your 401k, your IRA, your Roth IRA, whatever it is that you have. Go into those accounts and just double check the beneficiaries. Are you leaving the account to the right person? Did you get a divorce, right? Did you have a falling out with the person you were going to leave it to? Has your child suddenly decided that they have done something else and you don't agree with it and you want to leave your IRA or Roth to somebody else? Now's the time to check in on that. It happens all the time. Once a month here at Jazz Wealth, somebody, it's hard to say, but something happens to somebody, right? Let's just put it that way. And the IRA or their Roth needs to be left over to somebody. And unfortunately, some people don't put a beneficiary down. That makes it so much harder. It's so much more costly. It's so much more of a pain for that IRA to go on to the person that you want it to go to. So check that. Also look at your 401k. Now, in a taxable account, since we just focused on that, there is no such thing as a beneficiary. You don't have a Robinhood account or your TD Ameritrade, whatever it is that you trade, you actually don't have a beneficiary. You have what's called a transfer on death. And so that's essentially as close to beneficiary as you can get. A taxable account can simply transfer to somebody else upon your death. That sounds pretty self-explanatory. However, you are not required to fill that form out when you open a taxable account. Even here at Jazz Wealth, customers that have individual accounts are not required to fill out the transfer on death, but we can do it, right? So we can do it so that we make sure that they actually have, the account goes to where you want it to go, but know that it's called a transfer on death form. Very simple. A lot of times you can just do it online and sign for it real quick, no problem. Okay, number 3. Check your credit report, right? Now, if you're one of our customers and you've been in our budgeting class, the big class that we did over the summer, this is not a concern for you. If you happen to have bought the budgeting class and helped us, over the summer, we did a big, every year I'm going to do a big class. And this year we focused on budgeting, and it was all to support Drum Corps International, something that we really believe in. And so if you happen to have been a part of that class, then you know that you're done. Right? You don't have to check your credit report because you've already done it 3 times this year. I lay out specifically when to go and do that. So if you haven't done it, now's the time to go ahead and take a look at the credit report. You can get them for free. You can get the whole detailed credit report. I'm not talking about your score in this case. Your score is what it is. I'm talking about the actual report, the brief little report that shows you credit that's been taken out, your history, how things are going, any inquiries that maybe you didn't know about, soft pulls, hard pulls, all that stuff. Take a minute, dig into there, and actually just make sure the information's correct. It's not that maybe somebody stole your information, just make sure they didn't mess up anything, right? So everything is dialed in. Now's the time to go ahead and do that. If you're in our budgeting class, then you're done for the year. You don't have to do it again until next year, but I would put that in there. Number 4, high interest savings account. They're getting more and more competitive. You see it, right? You see the news of all these new companies coming out with high interest savings accounts. Whether they call it that or not is up for debate. But high interest savings accounts are more attractive these days because these banks are willing to pay more. Interest rates are going up. It is very competitive for them to lend money for personal loans, for credit cards, things like that. And so in exchange, they're offering the consumer a bigger chunk of that. You can get 2%, 2.1% if you really take a look. And those numbers are only going to keep going up little by little. So take a look around. One of the things that we do here at Jazz Wealth is, as our customers are using different services, they report back to me. They go, Dustin, have you heard of this? Have you heard of this company? I started using them. They suck, right? And then I hear somebody else, they go, hey, have you ever heard of this company? And I go, don't use them. I'm hearing bad stuff about them, right? Or I'll have a lot of customers go looking for high interest savings accounts. They have found a couple that they really like. So when somebody asks me, Dustin, which high interest savings accounts do we use? That's a perk of working with us here at Jazz. I can go, hey, listen, 100% of everybody that I've talked to, one of our customers that have used high interest savings accounts, they really like this company, or they really like this brand, or whatever it is. So then you know you're essentially getting real-time reviews from people that have nothing to really gain. They're just offering their opinion. And that's true for everything, whether it's the different mutual funds you're looking at, whether it's real estate investing, things like that. We get to sort of pass that information on to you. Either way, what I want you to do is I want you to look for high interest savings accounts. Take the time and do it. It's all done online. It's all electronic. It's not that hard. It's all liquid compared to your normal local bank, but you're going to get as much as like 20 times more than what your savings account is currently paying you. It's worthwhile, right? So do it. Well, that's the 4 things. I do have a couple bonus things for you if you have a minute. Number 1, I put down budget, right? Instead of going and downloading the calorie app because you're going to count calories this year and you're going to hit that treadmill, download a budgeting app. You don't have to use ours. Use whatever you want. But just make this the year that you actually dive in there and just see where your money's going. If it takes you all year and you refuse to create a budget, at least watch your money, right? I mean, some people really get offended when you say to do a budget. They're like, I know what my money's doing. It's fine. Well, then just watch, right? Just simply watch your budget, but download one of those apps. If you're one of our customers, it is our Nest Egg app is sort of an app now. You got to kind of get with me. I'm gonna do that on Thursday, help you out on our Wine and Wealth class, let you know how you can actually download our Nest Egg app. It is not Nest Egg, but how you can download it so that you can actually see it on your phone, see your budget, see your transactions and things like that. Just going to ask you to watch, right? Simply watch your money. You'd be surprised at where you want to cut your expenses or find better ways to spend your money when you actually see where it's going, okay? And then the last one I put down here, just because I was on a roll, it was, hey, your 401k contributions. You may be out of time for this. It may be too late, but are you on the bubble of one of the tax brackets? Take a look at the tax brackets. Take a look at your income. Have you contributed so much to your 401k that you're really close to being in a lower tax bracket? This may be the time to go ahead and kick in a few extra dollars to bring you down in the tax bracket, if that's the case. It's not going to be the case for everybody, but look, if you need to put in another $500 or something and it brings you down into the lower tax bracket, do a little homework. Take a quick look at that, see where you're at. Remember, your 401k contributions reduce your taxable income, so be sure to take your taxable income minus everything you've contributed so far, any other things that you could sort of round up as far as being able to reduce your income, and then see where that puts you. Should you maybe kick in a little bit more? I don't know. It's just a fun thing that you can look at real quick if it helps you there. So there you go. Oh, cool. I love it. You guys were married December 11th, 2018. Do you file? Well, the filing has not. Okay, so first of all, you're married, right? The question is, do you file married jointly or married separately? That's the real question. So you're fine. You're married now. You're officially married. You can do what you got to do tax-wise. But now I would talk to your accountant and say, most of the time people are going to do married filing jointly, but is there some weird reason, there's lots of little reasons, that you might want to file separately? I wouldn't be able to answer that just from a general question, but that's the real question to ask there. Do you actually have to sell off under the producing stock to write it off as a loss? So London, I think what you're asking is, do you actually have to physically sell the stock? The answer is yes. So if we go through December 31st, let's say you own shares of Ford for some reason, and you have a loss. You still own the stock. 100 shares, you're sitting there with a loss of, say, $100. And we go through December 31st, and you still have a loss. Doesn't matter. You're just carrying it forward. You haven't taken any action. So it's called a realized loss, meaning you have to physically say, okay, Ford, I have a $100 loss. I'd like to close the position and realize that loss, meaning I'll absorb it at that time. If you just hold the position and we go into 2019, then you have an unrealized loss, meaning it's on paper it's a loss, but it's not official yet because Ford could recover and you could do just fine. So it has to be a physical, actual loss. Yep. The clock starts for short-term and long-term capital gains on the day that you buy, and the clock stops on the day that you sell. Short-term capital gains offset short-term capital losses. Long-term capital gains offset long-term capital losses. Thankfully, a computer mostly does the work for you, and you'll just get a statement. You should be able to download statements, take a quick look, and see if you're taking a look in your active trading account. Brandon can't count to 10. Yeah, you know what I do? I go 10. That's how you do it. Does capital gains, loss, remove dividends, taxes? Capital losses actually reduce your taxable income. So as pertains to dividends, doesn't really matter at this point. The capital losses actually reduce your, I think that's the question, they reduce your taxable income. Dividends do count as your income, so in a roundabout way, yeah, it does. Can you make a video on investing in IPOs? You want to buy Airbnb? We could. I write an IPO article once a week. I actually just posted it today for a Polish company. You could probably find it if you look online. I'm not supposed to provide it in this aspect, but if you did a little research, you could definitely find it. So I write an IPO article once a week about what's going on. The IPO markets are done for the year, but you're right. You've got Airbnb, Lyft, Uber, Slack coming out. You're probably going to have one of the fintech companies later in the year, so that's going to be impressive. There's a lot of companies going public right now for the sheer position of buying fintech companies, so there'll be a lot of transactions in the space, I would think, but we'll see. You sure you don't want to be a financial advisor like my financial? I don't understand the question. That's what we do here. If you maxed out your Roth IRA, if fees been taken out, can you deposit more? No, so that's a good question, Don. So if you, let's say you have a Roth IRA and you're trading it and you're at like TD Ameritrade, right? So you buy a stock and then you sold it a couple months later, or you bought a couple things and you sold them, and it's $5 or $6 every time you press the trade button. That doesn't count, right? So that doesn't mean you can refill. Let's say in a month's time, you bought and you sold and you bought and you sold. Whatever, it adds up to $20. The $20 is not part of the contribution. So it doesn't mean you can now add $20 back into it. So no, sorry, I wish I had a different answer for you there, but that does not. Same as if you borrowed money from the IRA, or if you withdrew money during the year and tried to put it back. It's the same thing. So. All right, that's that. Let me make sure I got all the different comments. Yeah, so we actually did 6 different year-end things for you. So, I know we said 4, but we did 6 for you. I hope you enjoyed it. If we helped you in some way, hit the subscribe button. If you feel like you need help from us, you want to learn more, you want someone to help you with your investments, get everything straight for you. Of course, that's what we're here for. But if not, maybe you'll hit the subscribe button in the meantime. I think I said that already. You guys enjoy. I'll do a quick tour here in just a minute of what everything looks like. And then we'll be back at 5 o'clock for the closing beat. I look forward to it. See you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.